Hello, welcome to Pro Trader Strategies Market Commentary for Friday, February the 26th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about the economic data, the geopolitical environment, and how that all comes in to impact the markets with some of my market analysis. I do the same thing in these daily market commentaries, but I'm going to go a little bit further and talk about option strategies I'm trading on any given day based on the assumptions I come up with in my market analysis, or just basic portfolio theory for that matter. Anyway, without further ado, let's get on with the economic data, see how that's impacting the overall markets with some of our market analysis here. Across the pond, we got French consumer spending. That came in lower than expected at negative 4.6%, expected to be negative 3.5%, and they revised last month's number down. Preliminary CPI, consumer price index, coming in at 0.1%. Negative 0.1%, expected to be a negative 0.3%, so higher prices usually signals a better economy, as that is also an inflationary gauge. Well, we saw GDP, gross domestic product, come in at negative 1.4%, expected to be a negative 1.3%, so not really showing up there, but consumer price index is showing a little bit of inflation there. And then moving back to, actually one other thing, we got Spanish flash CPI, consumer price index, coming in at unchanged, expected to be 0.6%. Here in the United States, though, we got our core PCE, which is purchasing consumption expenditures price index. That's showing a little bit of inflation at 0.3%, expected to be 0.1%. Some of these high inflation numbers could be due to the fact that we're seeing crude oil start to move higher. That is going to be part of those inputs into that inflationary gauge. And we're seeing gas above $3 in most places, where just probably less than a year ago, we were right below $2. All right. Then personal spending. We got personal income coming in at 10%, expected to be a 9.4% increase. Well, they're not spending, though. They're getting paid more, but they aren't spending, as we're showing up in the economic data point here at 2.4%, expected to be 2.3%. Did revise last month's number down as well. Preliminary wholesale inventories moved up. That's probably because we're not seeing any spending going on. Well, it came in at 1.3%, expected to be 0.3%. And finally, we got Chicago PMI, Purchasing Managers Index, forward looking. Actually, we got a couple more, sorry. 59.5, anything above 50 is expansion. Expected to be 61, though, so although we are expanding in the PMI number there in Chicago, it is lower than expected. And then we got the University of Michigan Consumer Sentiment coming in at 76, expected to be 76.8, expected to be 76.5, so slightly better than expected there. And inflation expectations in line again at 3.3%. So a little bit lower here on the University of Michigan Consumer Sentiment for the last couple of months here. So on a downward trajectory there. Overall markets are kind of mixed. We're seeing that sector rotation back out of the blue chips and back into the tech, it feels like today. So let's get on with the overall markets. We can see here we've got crude oil just off a little bit by about $1, but still up into the 60 handles. That's going to keep your gas above $3, folks. All right, Bitcoin is in negative territory, but trying to make a bit of a move to the upside, trying to make a bottom here right around 4,500, which we did break below that earlier, and now starting to make that move to the upside. We've got a messy pattern here to me. This pattern, even if we were to make this top right there, that doji, looks like a continuation pattern for the most part. Anytime you get those counter-opposing dojis, it is usually a signal for a continuation, but maybe a pause because it's a Friday. Gold down $50. I don't know if it's going to hold on to the 17 handle. I was expecting an 18 handle, but we're seeing gold weakness probably because we're starting to see some of these interest rates move higher. A lot of people are saying because of that inflation. Well, if there was some inflation going on, we would think that gold would start to make a move higher in my eyes, but it's not. It's following along with these bonds. Bonds yesterday, last couple of days, big sell-offs. As a matter of fact, at one point in time, bonds were down over 3 points on the day, 3 full points on the day. Today we're down 23 ticks, which is just slightly, or up 23 ticks, I should say, but just slightly shy of a full point there, which is 32 ticks, 31 bid at even. All right, so just slightly shy of that at this point. VIX is coming off despite the fact that we have a mixed bag. Dow Jones, like I said, is off despite the fact that the tech sector is moving higher here, but we can see down 250 points. But the NASDAQ is up 100 points. Finding our 2018 trend channel. Now, I did go back in time and check these out. So this is the 2017 trend channel at about a 45-degree angle. And then in 2018, we were following that similar trend channel. I just copied and pasted it and slid it down just a little bit to mimic the trend that was happening in 2018. And they are basically perfectly parallel there, as you can see, even if I go back in time to go back to that. And then this is from the 2016 lows to the high of the pandemic, and then I threw on some extensions the other day, and you can see this extension, which we didn't have, the 123.6 and the 138.2 were not in there before. But look at this. Interestingly enough, we can see that this market has gone up and hit this Fibonacci that I didn't even have in there. It's found some resistance. So this is the high of that pandemic, the 50 Fibonacci. So when I did this, I did the 2016 low to the 2019 high, which was right before the pandemic, and then retraced it to that low, got those extensions, and that's where we're filling in here with the Fibonacci's there. Just pretty interesting anyway. E-mini S&Ps bounced off of the 50-day simple moving average yesterday, but today breached it just, albeit slightly. Today, we're going to really have to see how this ends up, because a finish towards the low is going to look like next week is going to be a bit of a sell-off. If we finish near the highs, or at least at where we are right now, unchanged for the most part here in E-mini S&Ps, that's going to make it look like we found a little bit of a bottom, because we bounced off of this 50-day simple moving average. Now let's look at the E-mini S&Ps. Yesterday, we did not get that turnaround that we've been getting after the daily market commentaries. The market actually continued to slide. One 15-minute time frame where we got a bit of a bounce, but it was completely retraced in weakness really into the close. Now, you can see on the open today, first 30 minutes of the day was just a massive sell-off to the downside here, getting a bit of a bounce in the last 30 minutes here. Or actually for the first hour, and this is the last hour, sorry. I forgot this is a 30-minute chart. But we're getting a bit of a bounce here in the overall equities. Now, with that being said, let's get on to my portfolio and talk about this. I just did yesterday a webinar on this clinic that we put on in PENN on doing covered calls. Now, I'm staying with this. I'm actually trying to get out of my 165 calls that are in the March for about 17 cents. Now it's trading around 57. Earlier this morning, we got a big sell-off in PENN, and I was thinking I was going to be able to get out of those. So I'm leaving that order in there as a GTC at this point for PENN. Maybe I'll be able to get it next week in early part of the week. IBM, I'm also trying to get out of my covered calls on this. Now, if you remember way back, I put this trade on for an earnings trade, sold some puts right around the 120 handle. You can see it's below where I got put this stock, but I have stayed very mechanical with this trade and lowered my overall cost basis in the IBM trade quite dramatically over time. And I'm trying to get out of the, like I said, these March 130 calls that I have covered. So I originally sold the 120 puts in there, got put that stock, started getting aggressive with that. I've lowered my overall cost basis on this trade by about, let's see, almost $5 on IBM. So albeit in my portfolio, it looks like I'm trading right there at 120, which is unchanged for what I have in my P&L, but I've lowered my overall cost basis on this by $5, folks. So a trade like this that just really isn't going anywhere, I'm still getting the $1.65 dividend or $1.63 dividend, but I'm also adding in over the course of this time a $5 reduction in what I paid for this underlying. So I am looking to try and get out of the, like I said, the 130 calls in there, it's trading right around 35 cents. I think I sold them for 54. So I've got a ways to go. I want to get in below somewhere right around 15 cents or something like that for that trade. A little bit further away, but I am still keeping an eye on this. Now, Home Depot, with Home Depot, I did roll this out in time as well. So if you guys remember with this trade, I have on basically what we were looking at as a diagonal or a poor man's covered call, however you want to look at it. And originally what I had done was the March, bought the 210 calls in there and sold the 285 calls for a $54.67 debit. So my break even on this trade is $264.67 when I originally put this trade on. Now we can see it's trading around 258 at this point in time, but during that time, 264.67 is my break even. I've lowered my overall trade by rolling the 85 calls out to the 295 calls in the February, rolled those February 295 calls out to the March 300 calls, and then the March out and down and from the 300s to the 285s now to collect another $1.94. All right, so all in on this trade, I've lowered my cost basis by about $5.70. All right. So lowered my overall cost basis $5.70. So my break even on this is right around 260. So very close to where we're currently trading. Now, if you only had this trade on, you'd be angry at yourself for the last year because it hasn't gone anywhere. But I have lowered my overall cost basis and been able to stay with this trade. Now, if it gets called away from me at 285, I don't care. I'm fine with that. I can just start going in and selling some cash secured puts somewhere around the 250 level and get back into this trade again with Home Depot. These are great trades, sideways trading for covered calls. It's like a clinic, guys. It makes my job easy, and I look like a genius when we're doing stuff like this. But staying with this covered call theory or methodology in my IRA and in my trading portfolio where we put on these trades. Sometimes they've gotten put to us in the stock like we did with IBM when we had a trade go against us. Another one where we're looking at something like Home Depot where I have on a synthetic long position and am just staying mechanical with that trade. All right, so it is getting down to brass tacks here where it's getting close to expiration on this type of trade. I only have a couple of days left in here with this, so rolling that out in time, trying to lower my overall cost basis on this trade. All right, so yes, I am a little bit extended on this. Got the long calls and then the short calls further out in time, but just trying to lower that overall cost basis and stay mechanical on that. All right, that's all I got for you folks. Other than one last thing, take a moment to go over our disclaimer as we're an educational company. I'm not trying to solicit you guys to do any of these trades that I'm doing. What I'm trying to do is use my examples to show you how we would be mechanical in a portfolio, stay on top of it, and increase our probabilities of success. All right, so if you can't take that, take it easy.